Good evening to those of you on the East Coast of the United States. Good afternoon to those on the West Coast, and good morning to those of you in China. It's wonderful to welcome so many of our friends to tonight's program. Normally, we do this program in person in the second week of January when Yifan, Yao Yang, and Yiping all come to the United States for meetings, and then we do a program either at Citibank or the New York Stock Exchange, which is a forecast on China's economy. This year, obviously, for the reasons of COVID-19 still raging in the United States and travel extremely difficult between the United States and China, we are doing it online. The good news is we have even a bigger audience than we have when we're in person. But it's wonderful that so many of you can join us. And I just want to thank the folks who sponsor this every year: Chubb, Citi, new sponsor Invesco, VanEck, and Xcoal, because without them, we wouldn't be able to do this for now the 12th time. This will be the 12th time we're doing it. And the reason I love this is because it always informs my view of what's going to happen in China's economy in the coming year. And we're always joined by the leading economists in all of China. And this year, because we have to limit it to just an hour and a half, we are joined by Yifan, Yao Yang, and Huang Yiping. Yifan, as you all know, is the Regional Chief Investment Officer and Chief China Economist of UBS Wealth Management. Yao Yang is what I often call my partner in crime, because he runs this with me, is a Chung Kang Scholar and Boya Chair Professor at China Center for Economic Research and the National School of Development. He's the Dean of the National School of Development at Peking University. Huang Yiping is the Jingguang Chair, Professor of Economics, Deputy Dean at the National School of Development, and Director of the Institute of Digital Finance at Peking University. And Yiping, as I do in every case, I will ask you about digital finance at some point in the questions and answers. So we'll start with Yiping, we'll go to Yao Yang, and we'll start with Yifan, we'll go to Yao Yang, and then we'll go to Yiping. But thank you for joining us so early in the morning, and we look forward to hearing your comments.
Okay, thanks, Steve. Thanks for inviting me to present the Chinese economy forecast for this year and also for the coming 5 years. So as we know, the 2021 will mark as the start of the China's 14th five-year plan. The announced proposal and the 2035 long-term goals have set the tone of the policy priorities over the medium and the long term, with a comprehensive initiatives covering the Chinese economy, technology, governance, culture, the environment, and openness amid an increasing complicated geopolitical environment. So the policymakers in China have pledged that the China will reach high income status by 2025, and that its GDP or national income per capita will double by 2035. So that implies a GDP CAGR target of 4.7% during 2021 to 2035. In other words, China will enter an era of the medium speed growth, with the focus shifting the quality growth after decades of the high growth. If the China maintains this growth rate, in our forecast, by 2030, the China's GDP will be similar to the US GDP. If we assume that US GDP growth will be around between 2 to 3%. So for the long-term goal, so we think that the drivers will be highlighted by the dual circulation strategy, tax self-sufficiency, urbanization 2.0, and the green economy to help the economy boost even as it is being rebalanced. So for this year, we think the China's economy will continue to recover this year, in our view, with GDP growth rising to around 9% from the trough of the 2.3% in 2020, led by investment and consumption, with a potential upside surprise from the exports. So, and also the GDP growth may then normalize to the 5.0 to 5.5% during 2020 to 2021. So the China could remain the main global growth engine and the world's largest market with a population of the 1.4 billion and a middle income, the huge potential market. So this year, we call this year, it's the China's market is a market of strength. So as we know, the GDP growth will rebound to around like 9%. So in our view, specifically for the consumption will show low teen growth. So especially for the retail sales, expected to post low teen growth like in 2021 after shrinking to the 3.9%. And also for the investment side, we still expect for the infrastructure, it will be led by the infrastructure and also for the property investment. So we expect this year and the fixed income investment will be still continue to grow like for the low teen, for the high single digit growth. And also for the credit side, there's a concern for the PBOC to probably to tightening the liquidity. So in our view, it's over concern. We think that of course there's a no easing, like as easing as last year, but this year for the policy side, we think will still remain relatively reboundant liquidity. So in our view, the leaders pledged for gradual policy normalization. In our view this year, and for the credit growth will continue to be around like a low teen growth. So that will be around like a 12%. So it's not bad growth. And we think that will continue to support the consumption and also investment, especially for the urbanization 2.0. And also for the tech self-sufficiency will actually bring some extra strength to the Chinese economy. When we talk about the risk, I think for the Sino-US tension probably will continue to be one of the risk. Of course, like later, Yao Yang and Yiping will highlight more. But here, I just want to say, for the China, one side to deal with this kind of the pressure, I think is do self better. So I think the currently reforms and openness are two major strategies for China to try to keep some external and internal balance and also implement its dual circulation strategy like in the current situation. So if we say that, we have to mention the recently for the last year, at the end of the last year, the China signed RCEP with the ASEAN countries and also plus some Australian, New Zealand, and also other countries. And also late December, China signed the Sino-Europe bilateral investment treatment. I think all these kind of the policies actually brings some China extra strength in complicated global environment and also bring China strength probably to have a big bargaining power with the US. So I just stop here and probably we can later to talk about more about this.
Great. Well, laid a great foundation. I would like to ask a ton of questions, but I'll let Yao Yang and Yiping speak first. So let me turn it over to Yao Yang.
Yeah, I'll mute myself. Okay, it's great to come to this workshop. Let me call it. It's usually we had this face-to-face forum in New York City, but this time we have to do this online. And I would like to thank Stephen Orlins and National Committee for organizing this, and we hope to continue our collaboration in the future. Yifan has just laid a good foundation for this workshop. So let me go details to the 14th five-year plan. As you know, China's two sessions, that is National People's Congress and the National People's Political Consultation Conference, will have the annual meetings in Beijing in early March, and the MPC session is going to formally announce the 14th five-year plan. Usually, when we talk about the five-year plans, we only treated them as kind of indicative plans. That is, they were just guidance. They were not meant to rigorously implemented. But this time, it's different because President Xi Jinping himself participated quite regularly in the writing of the plan, and he had several workshops consulting scholars and entrepreneurs. So this plan, I would say, is going to be more rigorously implemented than previous plans. Okay, it's a very comprehensive plan, as Yifan said, laid out actually gross target for the next 15 years. But here, I only want to talk about three major things that I believe will reshape the Chinese economy in the next 5 to 15 years, right? So those three directions are, as Yifan said, the first one is urbanization 2.0, or second wave of urbanization. Second is dealing with climate change. And the third one is technological independence and the robust supply chains. Let me go a little bit deeper into those three directions. First, urbanization 2.0. China's urbanization has been going on for 40 years. The pace was not slow. Each year we add about 1% of the rural population to the cities, right? But in the next 15 years, we are going to probably accelerate that pace. More than 200 million people are still going to move into the city. Okay, so that's it's kind of a continuous movement from the past, right? But then the new thing is that now the government wants to give up this even distribution of population, right? So in the past, people were encouraged to move to nearby cities, but this time, urbanization is going to be mainly around 9 so-called central cities, like Beijing, Shanghai, Guangzhou, Shenzhen. Then we're going to see probably 7 urban centers or urbanized areas in China, right? And we're going to see more people moving from second or third, fourth tier cities to first tier cities, or cities around the first tier cities. So population is going to be concentrated, right? That's going to dramatically change the distribution of China's economic activities, right? Those activities are going to be concentrated in a few urbanized centers, right? So currently in China, we are discussing about the decline of the north and the rise of the south, right? So that's actually just one of the signs for the concentration of economic activities. And together with that, the hukou system is going to be reformed. The government just announced a new policy to open up the hukou system, except those mega cities. Right? So that's first thing. The second is to deal with climate change. China has announced China is going to peak its emission by 2030 and to reach net zero by 2060. those two tasks are just daunting tasks. It's not that easy. For example, currently in China, coal still accounts for about 80% of China's energy mix, right? And China's emission is still increasing. And if Yifan's prediction is correct, then in the next 5 or 7 years, Chinese economy is going to be in a booming period again. And if the economy is booming, then emission is going to increase, right? So even to reach this emission peak by 2030 is going to be a daunting task for the government. But the government is gearing up its policies to reach those two goals, like to implement the carbon tax or carbon trading, green finance, also things, right? And we also see the electric vehicle sector booming in China. Dealing with the climate change is going to lay a foundation for the improvement of U.S.-China relations, right? We all understand that President Biden puts a lot of emphasis on climate change. I think that's going to be good for U.S.-China relations. And then the third area is technological independence and the robust supply chains. This is mostly caused by U.S. sanctions on high-tech exports to China, right? So China proposed this dual circulation strategy, and the essence of dual circulation is domestic circulation. And within that, I believe the essence is technological independence and to build a robust supply chains, right? So the government is quite determined on this, okay? To give you an example, in the semiconductor industry, China, the current self-sufficiency of supply of chips in China is about 30%, but in 5 years' time, China aims at fulfilling 70% of self-supply of chips, right? So that's a major objective, but China probably will invest heavily in the semiconductor industry and to reach that goal, right? China is also checking other areas to find out technologies that are potentially could be under American sanction, right? So with that, China wants to reach a robust supply chains so that can run by themselves if outside, if they are subject to outside sanctions, right? So overall, I would say those three major areas will reshape the Chinese economy, and of course that's going to have major implications for U.S.-China relations. Let me stop here. Thank you.
That's terrific. Barry Norton immediately asked this same question that I wanted to ask, which is more a clarification about the hukou reform. You know, Barry, like the three panelists today, is part of our Track 2 dialogue. And he said, you know, with the urbanization 2.0, isn't there a contradiction between saying people are going to move to 9 kind of central cities, but at the same time you're saying there's not going to be a liberalization in, you know, Beijing, Shanghai, and other cities? How is that going to work? How is hukou going to actually be reformed?
Yeah, that's a good question. Yeah, those mega cities will maintain their current hukou policy, but we are talking about urbanized regions, right? Like in Yangtze River Delta, we have not just Shanghai, we have Suzhou, Hangzhou, you know. other cities. Then in those other cities, they are going to have a unified hukou system. For example, if I live in Suzhou for 3 years, they all have those point system. I earn some points. So if I move to, say, Hangzhou or Nanjing, those cities are going to recognize my scores. So I can continue my scores. So that's going to make my hukou more easily.
Okay, Yiping.
Should I start? Yeah. Well, I guess the question I like to address in my opening remarks, it really is if the financial sector can deliver whatever Yifan and Yao Yang predicted for the next 5 years or maybe next 30 years. At the moment, if you follow the discussion in China, you probably will feel that that is a difficult task for the financial system. There are lots of complaints about the financial sector at the moment, but there are two issues always stand out in our policy discussion. The first complaint is that the financial sector no longer strongly supports real economic activities. And the second complaint is that financial risks are growing everywhere. So we needed to prevent systemic financial crisis. Let me go into these two issues one by one. The first question is, well, why is the financial sector not good enough to support economic growth? When China started economic reform, we only had one financial institution in China, the People's Bank of China, which was both a central bank and also a commercial bank. But from then on, we made major progress in establishing a very large financial sector. This sector, however, has a number of key characteristics. Number one, it's very large, as all of you would agree. Number two, it's dominated by banking sector. And number three, somehow the government maintained interventions in parts of the financial system, like interventions in the setting of the interest rate, the lending rate, allocation of funds, and so on. So this is quite unique in a way. It's very large, it's bank dominated, but at the same time, there's still a high degree of government intervention. However, if you look at what happened in the Chinese economy last 40 years, even though as an economist, we always criticize this financial system not as the best form, but you would agree that economic growth was fantastic, and the result, we can't really complain too much about an annual average GDP growth above 9% for 40 years. So obviously it worked, but now it not anymore. And the question is why? My own interpretation is that China now has entered into a new phase of development. In the past, we had a low cost advantage and the growth was kind of input driven and extensive growth. That's why the kind of state intervened, the bank dominated financial system worked one way or the other. The difference now is that we are up middle income country, and we probably will approach high income level relatively soon, which means when the low cost advantage is gone, you need to rely on more on innovation. And one specific issue is how do we support the SMEs, the private enterprises, because these SMEs now contribute more than 60% of GDP and 80%, 70% of corporate innovation and 80% of urban employment. The question now is that kind of financial system no longer works for a number of reasons, because government intervention would certainly reduce allocative efficiency. Bank-dominated financial system is not particularly suited to support innovation. And this is why I think this financial system needs to be revamped. This is the first thing. Bottom line is the growth model is changing, and the financial sector should also change. Otherwise, it will not be able to support economic growth. The second complaint about the financial risk. Now, I have to say, to start with, that China is probably the only major emerging market economy in the world that hasn't experienced a systemic financial risk for the past 40 years. However, the reason why we now seeing a lot of financial risks emerging in the capital markets, in the banking sector, in the shadow banking sector, and in the fintech area, and so on. Almost anywhere you can imagine about the financial risks, they're coming up. The question again is why? I think the key answer is that the reason why we didn't have a financial crisis during the last 40 years was not because of a very good financial regulation, but because of the two factors. Number one, continuously rapid economic growth. When the economy was expanding so rapidly, even if you made some problems during the development, you can always absorb it with very rapid continuous growth. Number two, government guarantee. Whenever there was a problem, the government would always step forward and shoulder the responsibility. And if you look at what happened in 1997, during the Asian financial crisis, it was very clear. The non-performing loan ratio of the banking sector was above 30%, but there was no bank run. The banks continued to restructure and to grow, and today they're already among the largest in the world. The secret is that, number one, the government took a responsibility to recapitalize, injecting capital, and restructure the banking sector, and so on. So there was no panic. And number two, because the economy continued to grow so rapidly, the non-performing assets we set aside at the end of the 1990s is already very, very tiny today compared to GDP. So these two factors supported the financial stability, but I'm sure you would agree, growth is already slowing, and the government will not be able to forever guarantee any problems coming up from the financial sector. So this is why we need a complete revamp of the financial sector in order to support economic growth over the next 5 to 30 years. The policymakers already outlined a broader picture or a broad framework of financial reform, and I will summarize them into 3 key areas. Number one, changing the structure of the financial intermediation, particularly developing multi-layer capital markets and raise the proportion of direct finance in total financial intermediation. Basically means direct finance and the capital markets should become a lot more important in supporting innovation, because they're probably more capable than the traditional banks in facilitating innovation. Here, there's also a question about the financial innovation. I'm not getting into it, but the fintech sector is really moving forward very rapidly in a number of areas, like a mobile payment, big tech lending, online investment, and probably also the central bank digital currency. China, in one way or the other, is leading in international development. That's happening, and that needs to happen even more quickly. The second change is we really now need to enforce market discipline. Let the market mechanism to play decisive roles in allocating resources. And one key area is about exchange rate, and more importantly, lending rate. The government has been making lots of efforts in supporting or encouraging the commercial banks lending more to the SMEs and the private enterprises and so on. I think we made significant progress during the last 5 years. The banks are lending a lot more, but they can only lend a lot more on sustainable basis on 2 conditions. Number one, you should be able to do the risk management effectively. This is why the technological progress in the fintech sector is very useful, because the traditional banks are not capable of dealing with credit risk assessment of SMEs, for instance, because they don't have a lot of financial data, they don't have a lot of collateral assets. But the big tech companies can do that relying on big data. That's one side of the story. The other side of the story is you should let market-based risk pricing. The government, in fact, is continuously pushing down the lending rate artificially, asking the banks to lower the lending rate every year. That is goodwill, but it's not sustainable because SMEs, by definition, is more riskier than other enterprises. So I think how to really implement market-based risk pricing is a critical challenge now going forward. Finally, the reform of the financial regulation, that is also important. We could no longer rely on the government to take all the responsibility for the problems that show up in the financial sector. So we needed to do a lot of things in the financial sector. Number one, we probably needed to focus more on the function, the transaction in the financial sector, instead of focusing on the institution. By doing that, by focusing on the institution, the problem was there are lots of areas uncovered. Like when you have a shadow banking, when you have a fintech, no regulators want to take a responsibility because they didn't really issue a license for them. That's something we needed to change. Number two, we also needed to enforce market discipline. The problem in the past was a regulator has two responsibilities. One is regulation and two is development. So most of the regulators, because they're responsible for development, they normally have a low tolerance of default and bankruptcy. When that happens, market discipline would not work. If the market discipline is not effective, then financial efficiency could not really be raised. There's also a question about innovation of financial regulation because the financial sector is moving forward quite rapidly. But we, number one, don't have enough resources in regulatory organizations. And number two, we probably don't have enough capabilities about it. And finally, I also think some accountability in the regulatory system is also useful. The problem in the past is whenever there is a problem in the peer-to-peer lending, in the small banks and so on, we all criticize these operators of these institutions. My question is, when these problems happen in one institution, we can always criticize the managers and owners of these institutions. But when the problem is very broad-based, like hundreds and thousands of institutions have the same problem, I think we needed to ask what was wrong with the regulatory system. I'll stop here.
Three terrific presentations. I mean, and I've got tons and tons of questions. So let me just follow right on to what Yiping said and just ask, okay, with these reforms, these financial regulatory reforms, what are the role for foreign institutions and foreigners in this? Yifan mentioned continued reform and opening, and you have brought it down to the financial sector. What is going to be the role of foreigners in this, and how much more is China going to open to foreign investors and foreign operators?
Right. Well, foreign players is always a critical force in financial reform and financial development in China. We, in fact, started the financial opening very early. But before I get into the details, let me divide the financial opening into two different categories. One is opening of the financial service sector, which really means introduction of foreign financial institutions to China to operate here. The other is opening of the capital account, so mainly cross-border capital flows. What is happening in China is I think the Chinese government has been much more relaxed and aggressive in opening the financial services sector. Certainly look at last 3-5 years. You probably know the government implemented more than 50 measures during the past 3-4 years, allowing foreign financial institutions to operate in China. That was very encouraging. In fact, I'm always very proud when we talk about opening of the Chinese economy. One area is leading was in the financial sector. Today, you can see wholly owned foreign financial institutions in China in many areas. I think they're going to happen more. These financial institutions are very important for the Chinese financial market. And they not just bring some capital, but more importantly, they bring new technology, new product, new business models, and so on. And of course, they also bring in a competition. So that's one area we already saw significant progress, and I expect that to continue. The second area, capital account liberalization and opening of the capital markets. In fact, I think that will be the main breakthroughs during the 14th five-year plan. The government is already trying to put together some plans for opening the capital account, and as alongside restarting internationalization of RMB. I think we should all pay attention to that particular area in the next 5 years. I'm pretty confident. I think we're going to see significant breakthroughs in that area. So it will be a lot easier for foreign investors to come to China, to invest in the Chinese market, to hold RMB denominated financial assets within 5 years.
And that, I assume, is part of the confidence that the leadership has today in the Chinese economy, that you liberalize at a time when your reserves are strong, when FDI is flowing in, when the capital account is growing. Which brings me back to Yifan to ask by the way, I couldn't hear at one portion. Did you give a date at which point you said the Chinese economy, you give an assumption 2% US growth, China's 4.9% growth, when the two would cross? Did you say what year that would be, when China's economy would become bigger?
Okay, so if we assume the US growth will be 2%, the China's growth will be around 4.7% CAGR growth, and then on the 2030, and for the US and China GDP will be similar. If we assume US at 3%, then it will be 2035.
And if it's 2%, it's what?
It's a 2% of the, if we assume the US GDP 2% of the growth. So I think by China is around 5% of the growth. So by 2030, so the China's GDP and the US GDP will be similar.
I see. And does that take into account this enormous difference that have occurred in the last 12 months of almost, China rebounding from COVID quickly and America not?
Yes, but 2021 will be an outline. So this year, the China's GDP growth will be around 9%. So we just assume streamlined to 5%, and then that will be the case. So it's already take the factor.
I noticed, the confidence, the confidence measure that came out recently weakened quite a bit in China. I noticed that we're having the Chinese government controlled COVID so well after the initial outbreak, but now we're seeing outbreaks and we're seeing lockdowns. Do you think it's going to start affecting? And I assume over Lunar New Year, I've heard from many people they're staying home so that the surge in travel that generally occurs around the New Year is going to be much more limited this year. Have you taken that into account, and what does that mean for going forward? And is there some risk that, sadly, we're seeing mutations of the virus, we're seeing higher transmissions. Is that a risk to your forecast?
We already take into consideration of the forecast. So yes, I think that during the Chinese New Year, there's still like a large migration of the workers, like a return hometown. And I think for the Chinese government already applied a lot of like measures, try to control the potential opportunities to spread the virus. Of course, it's not like a fully controllable. So, but we already see there's many measures that's already applied. For example, almost everyone like a returning hometown have to take the nucleic like acid test, and also have to like if there are any things like there's a mini lockdowns if any suspected cases happen. And also I think that now for the vaccination, I guess like it's also like I think will be the final solution for the US as well. It's also largely applied in China, especially like for the vulnerable positions. So I think combined with like well-managed measures plus the vaccination, I think we still think the vaccination, the virus can be largely controlled. So the consumer confidence is gradually picking up. But of course, we are not seeing like for the virus will disappear this year, but it might exist for a long time with the human beings, but we think that it's still like manageable, especially in China.
So then your base case for 2021 is 9%? 9% growth?
Yes, it's around 9%. So it's like, I think this year for the consumption will catch up, because last year for the consumption is still at 3%. It's mainly led by the investment and exports. So this year we think the exports will continue to be strong, especially supported by the infrastructure and also property investment. And for the consumption side, led by the auto and also some discretionary and also like a staple consumption. And also we saw the transportation and maybe for the tourism and also for some service sector, entertainment service sector, so will catch up gradually. So that's actually gives some additional strength for the Chinese economy.
Yao Yang and Yiping, is that basically where you are for 2021, around 9%?
Well, I don't make a forecast anymore, but I see the range of forecast in the market, and IMF just gave a number 8.1%. So I would certainly trust the Yifan's forecast, and it could even be higher.
Mm-hmm.
But we have to discount the base effect last year because we had a very low base.
Yeah, a lot of that is based upon the way China calculates it. Yeah. Yao Yang, is that about where you are?
I actually have no idea. I don't do forecast, but you know, since the Yifan has done a lot of research, I tend to believe her.
And what does this mean? What is the, you know, with these flows and the very optimistic view of China's economy versus the rest of the world, what does it mean? And Yiping made reference to internationalization of the RMB and potentially making it more, the valuation more market-based. Where do you think the RMB ends up when we do our forecast in 2022? So a year from now.
This question for Yifan or for me?
Anybody who wants to answer.
Well, I'll have a go, and Yifan probably. Yifan she is a chief investment officer, so she probably knows better. My general sense is that if the Chinese economy does better than the rest of the world, still there is a possibility that the currency should continue to appreciate. But the question here is when the determination of the exchange rate is affected by a number of factors. And in fact, the relativity is very important. So for instance, even if China is growing more rapidly than the rest of the world, but if the US and some other developed countries recovered faster in relative terms than China, maybe their currency could even be stronger. There are a number of other factors I think we should take into account. Number one, What is going to happen to the Federal Reserve Bank's quantitative easing? If they start to tighten, that would affect the interest rate, liquidity, and exchange rate of RMB in China. Number two, capital account liberalization in China, which I predicted would be the main breakthrough next 5 years, would also have some implications for the exchange rate, because our past capital account liberalization was easier on inflows, but more difficult on the outflows. So really, capital account liberalization in the next 5 years, meaning easier for the residents to invest overseas, that would also affect the exchange rate. So my general prediction is that the currency could stay strong if the economy does better than the rest of the world, but there are many other factors we should keep in mind. My main argument is that we should always avoid adaptive expectation about the exchange rate.
Yifan?
Yes, I agree with Yiping. So I just want to add here. So this year we forecast the USD could be relatively weak comparing with the rest of the currency. The reason I think is the main reason is still the dual deficit. I think because of the strong stimulus package last year for the US, for the fiscal deficit is close to the 16 to 18%. And this year with 1.8 trillion of the stimulus, and we expect for the deficit will continue to be around 15% of the GDP. So that's huge gap. And also plus for the US for the external deficit. So the dual deficit will keep the dollar relatively, I'm not saying a very weak, but at least will not be as strong as previous years. So that's actually gives some opportunities for the CNY. So for the RMB, we think this year will at least be relatively stable. So that's actually it's for the it's already that will be actually very attractive for the international investors. So especially for China's a bond market, because this year for the China, for the government bonds will be included in the World Government Bond Index. So currently for the China 10-year Treasury bonds is about 3.2 to 3.4 return, comparing with for the US around 1%, or for the European countries is around 0%, plus stable, relatively stable for the stable CNY. So that's very attractive for the international investors. So for the equity market, because of the rebound of the Chinese economy, we also expect for the corporate revenues this year for the Chinese market in general will rebound around 20% by the end of this year. So that's actually brings some additional strengths for the investors for the secondary market. So as EP mentioned, for the financial services, openness, I think at least we are on the right direction. I think it's I think it's a good sign. I think besides the financial, for the financial sector openness, I also wanted to highlight for the China further openness in many other fields. So that will also bring some attractiveness for the investors, for the direct investors in China. So I think the major, mainly it's including for the manufacturing sectors, more sectors, more sectors will be open, especially highlighted in the Sino-European bilateral investment treatment, and also for the RCEP, that's including transportation, telecommunication, and auto sectors. And also we will have open for some service sectors, especially for the health sectors, for the private hospitals could be open to the foreign investors. And also for the R&D sector, for the R&D field, especially for the biological resources, could be limited access to the foreigners as well. And also for the cloud services and telecommunication I mentioned, that's also part of the services could open to the foreigners. And also for the international, maritime transportation, and it will be also for the foreign investors. So that will be very attractive. And also for the air transport related service will be like open. And also especially for China now put emphasis on for the green economy. So we think that there's a lot of cooperation in the environment, especially like for the ESG highlighted by the government. I think it's also in the future will be actually required to be included in disclosure, especially for the listed companies. So I think with all this kind of the openness, plus all this kind of the recovery, and also for the relatively stable CNY. So the China, actually, we call the 2021 is a year of strength, could be very attractive to the international investors.
Yeah, that spread to US Treasuries has narrowed over the last few weeks, but it still is quite significant. It should bring in more money. By the way, are we going to have a real estate tax in China? That's been talked about for years. And what's that going to do to kind of the overinvestment in real estate? Any of you want to hazard a guess on that? Yao Yang?
Yeah, I think the real estate tax will be implemented in 5 years. The government has stated this clearly, but I don't know the impacts on that sector. It could have some effect on speculation, but if the government gives some time for people to respond, then people will first sell off their house before that, right? So in general, it's going to be good for the whole sector and also for the economy.
Yeah, I want to add here. I think it's a good tax because, like, at least could tax the rich people, and also that's the purpose of tax. And also, I think that could probably curb speculation. But also that could affect the wealth. But in China, in my view, there's a lot of that the policy will be more like a local policy, localized policy. So catering to the local structure, local for the ownership structure. So currently we know it's already for the Shanghai and Chongqing has a property tax. And but they also have the exemption for the maybe for the first house for the families, and also for the house value the valuations also have some flexibility. So I think it's in my view it's very likely in the future. So we will have maybe for the first house exempted from the housing tax. And also probably we will tax for the new housing first. For the existing ones, maybe we'll tax when it's in transactions. And also for the tax rates, really depends on locally. I think that's ranging from 1% to 3%. So it's really it's also. So it will be relatively flexible. Technically, the China now it's ready to levy the tax. So I agree with Yao Yang. It's probably in 5 years after the property tax. Then it's probably it will come with the inheritance tax as well.
Studying America. Yiping, you're head of the Institute of Digital Finance. Can you tell us about where the central bank digital currency is? And whether, in part, this is a way for the central bank to have better data to set monetary policy.
Well, the central bank already finished the design of its digital currency, what we call now ECNY. From last year, they already, the year before, they already experimented in a number of cities, like 4 cities, but also the Winter Olympic theme. So they experiment. I think the question now is when the central bank will feel comfortable with the technology, the operation of the mechanism itself, and then it could be rolled out. I used to say the ECNY can be rolled out relatively quickly, but I've been saying it for some time and still not yet. So I don't know exactly when. And if I have to make a prediction, then I hope the ECNY will be in our digital wallet during 2021, I hope, but it may not happen. Your question about whether this is might be a step to facilitate better monitoring of the financial system for better monetary policy making. I think that is probably quite a few steps away from us. ECNY really is a form of electronic payment. According to the PBOC officials, this really is only substitute for currency in circulation. And to some extent, this is very similar to the mobile payment service we're already using, like WeChat Pay and Alipay. The difference is this is directly issued by the central bank, while Alipay and WeChat Pay is RMB in electronics form, but created by these institutions themselves. So I think the direct impact, there could be some substitution with the existing mobile payment, because this is also a mobile payment, and to some extent, it might actually be better than the existing electronic form, because this is a legal tender. It's safer, and it's also probably more cost effective, because the PBOC is not going to charge somebody like for using digital currency to make the payment. So these are all good. But there are two things I like to just highlight. Number one, this does not necessarily mean it will completely push out the mobile payment service, because the idea is that we're probably going to have 9 authorized institutions developing their own digital wallets. These 9 institutions, including Alibaba and including Tencent. So the wallet could still be there. And in fact, in the future, in Alipay wallet and in WeChat Pay wallet, you can also directly use the ECNY instead of what they're using at the moment. So these wallets will continue to exist. They're not going to be pushed out. But at the same time, there will be competition, because there will be 9 digital wallets, and at the same time using the same ECNY. This is the first thing. Definitely there will be competition. The second thing, as a result of that, I think more important is that after 9 wallets are introduced, the information, the digital footprint these mobile service and payment service operators collect before may become segregated. Meaning, if I use Alipay to pay your ICBC wallet, then Alipay would only know this part of the transaction, and ICBC would only know the other part of the transaction. The two of them, neither of them would have a complete picture of the entire transaction. The only organization will have the full data is the central bank. That, I think, could be a significant change. And in fact, it could affect the future landscape of what certainly would be important for data policy, but may also affect the landscape of digital finance. This is, in my view, much more important than competition for mobile payment and implications for monetary policy. I think will be sometime like a bit distant away from us.
Fascinating. My last question, then I'm going to go to audience questions. There was enormous debate today on a listserv that I'm on about China's fertility rate and the enormous drop that appears to be occurring in China's fertility rate in some places. These are reports not from the central government, but from the local governments. In some places up to 30%, which is truly extraordinary. And obviously that's not COVID data, it's data that related to the births in 2020, which was obviously, they were conceived mostly in 2019. Number one, is that likely the case? And two, what are the implications of that for economic growth?
Yeah, let me take that question. I think those data are quite alarming, but looking into the future, probably there is no way for China to reverse this trend with declining fertility rate. China is going to look like our Asian neighbors. So think about Japan, Korea, their fertility rate is about 1.4, even below 1. Right? So China eventually is going to reach that stage, no matter what kind of government policies are going to be conducted, right? But what are the implications for economic growth in the future? In our China 2049 book project, we did some analysis. We just found out actually we don't need to worry about labor supply because of automation. Actually, automation is going to more than compensate the loss of labor force due to population aging. Right? And we probably don't need to worry about consumption like Japan is worrying about, just because China still has a lot of people living in the countryside who are going to move into the city. That's going to automatically increase consumption. So to become old before getting rich is actually good for China in this case. The biggest challenge is the social security. Right? In 10 years or 20 years time, when our generation, Yiping and my generation, gets old, that's going to be a huge challenge, right? But China still has some room to deal with that. It's China's public assets, right? It's about 200 trillion net assets in the hands of the government. So supposedly the government can just sell off some of the assets, then use the money to subsidize the social security system. So we can get by this huge wave of aging. Then after 2050, population is going to stabilize. So that's going to be much better than the next 20, 30 years.
Yifan, give us a view on where you think, well, this is from Vincent Zhu at the Rhodium Group, of where you think China's current account and trade positions, surplus, I think is fair to say, for 2021 are going to be in this coming year.
In 2021, of course, we still expect for the surplus, for the Chinese current account. Especially we also expect there might be a surprise in the export side as well. So with the direct investment, of course, I think because of the large capital control outflows, so I think the overall for the capital account is also will continue to keep the surplus as well. But at the same time, we also see the trend for the falling the balance of the current account. I think that currently, before we used to run 4 to 5% of the current account surplus, then gradually fall to the 3%. Now it's maintain around between 1 to 2%. So we think that would be the trend. So overall speaking, I think that China will still have the very have the strengths for the exports as well as for the attractiveness for direct investment. So we think that will still keep its current account relatively balanced, especially even around the surplus.
Any chance that the restrictions on capital outflow are going to be lifted?
Actually, recently for the capital account, there's some because of the strength of the CNY. So I think in the late December, there's some relaxation of the capital outflows, especially for the person for the household account. So I think that there's some new measures and to allow for the household to maybe transfer out some of the for the capital. I think that if they the capital gains outside from China. So I guess that's really depends on for the CNY strength.
Is that part of financial reform, Yiping, that you think about? Relaxation?
Yes. Well, in fact, as I said, my expectation is that internationalization of the currency and liberalization of the capital account will be the key focus in a financial opening over the next 5 years. The question about the timing, I think this is kind of a tricky question. In the past, we always focus on trying to find a better time to liberalize when the macroeconomic situations are sound. But now I think looking back, the experience of most developing countries suggests that that might not be the ideal strategy. When the macroeconomic condition is great, you liberalize the capital account, there will be lots of capital inflows and you feel happy because more liquidity, high property prices, stronger currency, and so on. And you all claim that the international investors are voting with their money in confidence in our system. But the problem is, as you know, when capital moves in rapidly, there always will be a point when these flows return. And when the money is moving in, you could easily lead to asset bubbles, overvalue the currency, and so on. So you often end up in a financial crisis. I think the current thinking now is maybe timing is less critical than the method you liberalize. What is important for us to liberalize going forward is we need to be careful about the sequencing of liberalization. The real sector first, the financial sector follows. The domestic economy first, and the external economy follows. And exchange rate first, then capital account follows. One very important new thinking is that whatever way we liberalize, we always need to have macroprudential regulations in place, which means even when we liberalizing, we're always thinking about the bad times and make sure that risks don't accumulate excessively. That is the strategy I think we should always keep in mind.
Yeah. Let me go to audience questions. First one from, well, we've already done one, from Sheldon Pang, one of our directors for Yao Yang. You know, you talked about kind of green finance and climate change and the efforts there. And he says China started a nationwide carbon credit trading exchange. Given China's ambition to make real progress in curbing emissions, many people are very disappointed at the initial implementation of the scheme, in that the penalty for non-compliance to pollution quota is so minimal, 20 to 30,000 RMB, and that foreign invested companies in China are not allowed to participate. A number of observers feel this is an example of the central government being fooled by people below. Do you have any comments on that?
Well, I'm not an expert on this, but I tend to agree with the opinion by my colleague, Professor Xu Jintao. He's an environmental expert. His idea is that carbon trading is not the direction for China to go, because it really requires a lot of regulatory tests. So he actually favors the carbon tax, right? And the carbon tax belongs to local governments. So local governments then have a lot of incentive to cut the tax, and then so that's going to be much better for curb emission.
Yeah. Arthur Krober asks all of you, the 5 to 10 year views you have expressed are in general very optimistic. what are the major risks that could cause China to fall significantly short of its growth objective over the next decade? So what are the downside risks? What can go wrong?
Let me go first. I think the biggest risk is the deterioration, the continuous deterioration of U.S.-China relations. That's by far the largest risk, right? So if the U.S. continues the Trump administration's policy, and then China's economy is going to have much more trouble, right?
Yiping?
Well, there could be other risks. Number one, for instance, if we don't manage the financial risk as well, and unfortunately, if we end up in a systemic financial crisis, then we're not going to make that target. The other thing which is very important is the ability to innovate, because non-growth is innovation driven. I'm not really talking about very high-end innovation. We're competing with the US chip industry and so on. What China needs to support the growth over the next 5 to 15 years is really improvement on the existing level of technology. Like if you're making electronic products, you're making automobile, we need always to advance in that direction. We're certainly doing well so far, but there is a bigger question if we can continue, particularly in light of what Yao Yang just highlighted. If external environment becomes really very hostile, I think there is a potential risk there.
Okay, so I think, I agree with EP and Yao Yang. I think another risk I can think of is still for the leverage, the macro leverage. I think it used to be a very big concern in the 2018, and then I think it's probably like it's like because overwhelmed the Sino-US tension. I think it's put aside. And also, of course, the China stimulus package is not as strong as like the US last year, but still it's a quite significant package. So I think that actually will continue to push up the macro leverage, especially like I think with urbanization 2.0. So that means like for the local government has to spend more on the infrastructure. So I think it's probably not only the phenomenon for China, it's a global phenomenon, but I think it's still like a concern for the longer term, because not only for the local governments, but also for the households. We also see for the leverage actually increase quite a lot. So for the leverage, not only have the growth issue, but also have its structure issue in China as well.
Is it fair to say that the greatest risk is that their vested interests in China that don't represent the majority, but that really don't want and don't benefit from reform, and that those interests can have real effect on decisions relating to reform? And isn't the greatest risk that the vested interests who don't benefit prevail, reform doesn't occur the way it should, and the economy begins to slow more and more?
I give a quick answer. Maybe I think EP and Yao Yang can add. In my view, yes, I think it's indeed for the reforms has become harder. I think at the current stage, because it's have the combined interest group. However, I think the situation, in my view, has actually changed a little bit since 2018 because of the pressure of the US side. So I think the tension, of course, like on one side, I think it's also have the negative pressure on China's economy. But on the other side, I think it's also pushed China's like openness and the reforms. So from this sense, I think the largest opposite party for China is the US, probably the same situation for the US as well.
And let me add to Yifan's comments. I agree with her. Over the last 2 years, China has done a lot of reforms through the foreign channel, right? For example, there's BIT with European Union is going to bring major reforms to China, and also because of the U.S. pressure, we had there's a new foreign direct investment law that changed the situation quite a lot. Actually, I don't worry that much about reform. I don't think, to me, seriously, I really don't think a reform is the biggest challenge for China. The biggest challenge for China is that domestically is that the policies are quite often guided by emotion instead of a rational discussion and a calculation. That's the risk.
Interesting. Yiping, Bob Donor has a question for you, which just disappeared off my, there it is. It says, Bob Donor, also a member of our Track 2 dialogue, removing a government guarantee and moving to market-based credit supply is inherently difficult, particularly if there is a large existing stock of credit. Will the Chinese government try to engineer a managed pace of credit distress and bankruptcy, or will it shift back and forth between market-based risk and government guarantee?
I guess Bob already implicitly provided an answer to that question because he knows China so well. I think the strategy of the government now is they realize blanket guarantee doesn't work anymore. You cannot sustain. Therefore, a few years ago, the government already decided that they should let some risks to grow up in limited areas. But the question, I think, the problems is that once you let some risks to come out, there is a potential that it might spread to some other areas. Then the policymakers would become quite worried. We saw a number of cases during the past years. So for instance, a couple of years ago, you all know there was one bank in Inner Mongolia, Baoshan Bank, had a problem and it was restructured by the regulators. There are some other problems and look around, and I think the government became nervous. So they didn't want everybody to to show up their problems. So my guess, my answer to Bob, I guess, is that now we have the right strategy of manage the release of the risks. Hopefully, there would be no systemic risk. The challenge is always that the trade-off between the two is always very difficult. So we don't know if we will see one of these two extreme risks. Either you're always trying to release some risks, but you worry about the big problems, then you go back to the older regime. I think that's what we're seeing at the moment. The other risk is if you become bold enough and you make more progresses, then there is also a risk to see widespread problems in the financial system. At the moment, I don't know what will be the exact outcome. I certainly hope the middle ground, what the government is hoping that is gradually release some risks at the same time strengthening the regulation, and hopefully some of the existing stocks of problems can be resolved even if we don't let them blow up, like what happened with the state-owned commercial banks in the late 1990s. That's the ideal route, but there's no guarantee that this will happen, and this is why my number one potential risk for Chinese growth trajectory over the next 5 to 15 years is a financial risk.
A number of people asked about semiconductors. Let me ask Liz Economies, one of our directors also, and she asked, China had a target of 40% self-sufficiency for semiconductors by 2020. And as was stated, 70% by 2025. But it has already missed the 2020 target by a wide margin. And many of China's investments in this area have collapsed over the past year. What gives you confidence that China will achieve its 2025 target?
Let me try to answer this question. China missed the 2020 target probably it's because the U.S. Didn't give China enough pressure. That's probably not true because of the U.S. pressure, China is gearing up investment into the semiconductor industry. Yes, last year many local investments collapsed, but that's not going to stop China investing in that industry. Currently, the government calls for private equity funds to join hand with local investment funds. I think much of the investment is going to go to high-tech areas in which chips industry will be a major target of the investment. And also, if we think about those low precision chips, China actually has quite a strong manufacturing capacity. So China can probably start from this area, then gradually move up the ladder to produce high precision chips.
Anybody else want to comment on that one? David Utes, a former employee of the National Committee, said in 2019, China committed to large purchases of agricultural and other products that were to some degree paused by COVID-19 crisis. Will China return to those purchasing commitments this year? And are there other economic measures that China could take that would demonstrate good faith to the new Biden administration and encourage reciprocal improvements in U.S.-China relations?
Okay, so for the phase one deal, although it's handicapped by the COVID-19, I think the China still try to made its commitment. So actually, by the data is by October, by the November 2020, the China actually from the agricultural goods already fulfilled by around 80%. So the speed actually caught up very rapidly since for the second half of the last year. So in our view, although with the increasing pressure from the Trump administration, the China still still try to commit its made its commitment. So in our view, for the trade one deal, probably will continue if there's no other disturbance. But it also really depends on the new relationship between the Biden administration and China. So I think the China now is wait and see to see what will happen for the new administration.
Yiping or Yao Yang, any suggestions on that for that one?
Well, I think if phase one is still a legal document, then the Chinese government will continue to implement. Although there was a question even in the US when the agreement was signed, if the target of purchase was practical enough for the two sides to fulfill. So this is one issue I think we need to look at. And as Yifan suggested, we are at the moment hearing from media reports a lot of different information messages about what the Biden administration is going to do about it. I think so the two sides will probably need to come together and to make a position on this. But bottom line is I'm sure the Chinese government will need to make more efforts trying to liberalize its economic system. Issues like better protection of intellectual property rights, opening of the domestic market, and hopefully also reduce subsidies to state-owned enterprises. These are the areas the government already committed, and if China can do some of it, I think it would show goodwill in cooperating with the Biden administration. Just to finish, I think one thing we all should pay attention to is that the Chinese government made a clear message about its interest in joining CPTPP. If that is the case, I think the potential reform program would be way beyond what we have in mind, because the CPTPP is a very high level opening regime standard. And the Chinese government said it's seriously interested in joining it. So I think we could see potential progress in structural reforms. But again, what is going to happen to large extent also depends on the atmosphere of the bilateral relations.
Yeah, I think that CPTPP statement is absolutely true. It would mean massive reforms in China. And I mean, I would expect that in an agreement, you would need a long pathway for China to ultimately comply. That's one issue you would need to negotiate. The other is each of the countries have veto power over any new entry. So the question would be, would Japan or other allies of the United States be willing to even negotiate an admission of China while U.S.-China relations are, deeply troubled? And I would argue, I think David's question is great. China, obviously, the benefits of the comprehensive agreement on investment with the EU will also flow to the United States. So that, it has most favored nation provisions, I think. So that will be a benefit, and hopefully the United States and U.S. businesses will invest in China and by doing that, create additional jobs in the United States. But China should begin the process of cutting tariffs that were imposed during the Trump era. They're no good for the Chinese consumer. They're no good for American exporters. And I'm confident, President Biden in his campaign, and since then has talked about the loss of jobs as a result of the U.S. imposition of these tariffs. So it failed. It not only failed to generate jobs in the United States, the analysis is that it lost jobs. I think the number that the campaign used was around 250,000. So both sides can enter into negotiations to reduce tariffs, which help both the people of China and the people of the United States. Any final, I've got another 25 questions, but we don't have time to ask them, unless if there's one that jumps out. Someone is asking, what would capital account liberalization look like?
Well, IMF has a category of 40 different areas of cross-border capital flows. Capital account liberalization would mean, if my prediction is right, by the end of the 14th five-year plan period, which means by 2025, we should achieve what IMF defined as basic convertibility. Most of the items, the categories should be open for two-way capital flows. But obviously, the authorities would probably want to retain some restrictions on short-term capital movement for the purpose of financial stability, anti-money laundering, and a number of reasons. So that is, I think, what the Chinese government is aiming at. The idea is that for all economic and political reasons, China has developed into such a stage that open capital account is a must for China to continue to rise. But at the same time, we also need to be careful about the potential risks. So there will be some restrictions, but a small number of restrictions remain, plus some macro-prudential regulations. Other than that, the capital account should be largely open within 5 years.
Fascinating. We've come to our closing time, and I know all of you have to get to your day jobs, and we will get to our nightcaps here on the East Coast, but I can't, Yao Yang, Yiping, Yifan, I can't thank you enough for being with us this evening. I can't thank you enough for being such great participants in our Track 2 dialogues and always being available when the National Committee asks for your help. But I have learned a ton tonight, and I am absolutely certain our audience has learned a ton and really informed us about what's going to be going on in the Chinese economy in the coming year. But thank you all so much. It has really been terrific. And audience, thank you so much for joining us this evening.
Thank you.
Here's Steve with this
Thank you.
wonderful hosting.
Bye-bye.
Yeah, bye-bye.